Okay, folks, just a little bit of commentary on the euro dollar. And I want to kind of like walk forward with this kind of like one day at a time. See how price starts to move above this short-term high, which we'll draw a small little trend line off of to delineate a horizontal resistance price point. You see price eventually trades through this high, and it's a break in market structure. So we go back down to this low. I want to anchor a fib on the lowest portion or of it, open or a high. I'm sorry, open or a close. So we're focusing on the bodies and the highest open or close in the swing here. Now, if price trades through it, then we'll use the higher bodied candle to anchor it to. But for now, we're looking at this area in here. Okay, and price trades down into it right there. At that moment, that would be a buy, and we would be targeting this old high back here. Okay, your first scaling profit. Price starts to run in here, and I want to kind of like show you something right in here. Okay, we have a low that's violated here, and price rallies away. I'm going to put a horizontal line right here on the order block. So we'll have a couple different things we can reference in here. The open on this particular candle comes in at 1756, which you see here, 1756. Now I'm going to drop down into a 15-minute time frame. Okay, here we are on a 15-minute time frame for the euro dollar. We can see price starting to rally. Here's that 79-cent retracement level here. Now it did violate it a little bit in here, but we rallied through and showed a break in market structure even on a 15-minute time frame right here. Price rallies away, eventually takes out short-term high, and then what does it do? It goes into a deeper retracement and right into another optimal trade entry. And notice it trades down to the 62% retracement level relative to the Fibonacci that we've overlaid on the daily chart. So it's a higher time frame daily, but notice also what we can see in reference to this price swing. You can see price has another opportunity of an overlapping optimal trade entry body. Why am I using this one and not this one down here? This one has the most dynamic price action. Away from this low, yes, it was a nice little rally, but here, a lot more energy behind it. And I'm using the body high here and low as a reference point. And we have the 62 and almost a 70%, 70.5 rather, percent on a fib retracement right there. Now, if we use this low here and use the lowest body of the candles there as well, we can get a really nice overlap as well in regards to the 79% level. Here, your 79% and the 70.5 level. And I'll move it around again so you guys can see it. Okay. So there's a lot of confluence right there. Now, as price was dropping down, that would probably be a little scary, a little frightening for someone that would be either bullish or in a long position. And it could have stopped you if you had trailed too tightly on trailed sell stop. And now what I want to look at is one of the patterns that I believe are very, very strong. And it's the breaker. And you'll learn about this also in the tutorials. But in here, I want you to take notice of that low. This is an hourly chart. This low here has a bunch of sell stops below it. How do I know that? Well, price trades away and rallies. So anytime that occurs, we simply assume that there's going to be a liquidity pool of sell stops resting below that. Price trades lower, takes out that low right there, sell stops are gone, and then price rallies. At some point in the future, when price comes back down into this high, it will be bullish. Okay, and I'll teach you all the reasons why that's the case in the tutorials, but for now, just notice that if we have a low and then a lower low and price rallies and breaks market structure, when that occurs, go back to the old high here. If price trades back down into that, as we see here, it's bullish. Now, we also have examples of this in form of bearishness. This is a bullish market structure pattern. A bearish market structure pattern would be this one here. We have a high, price starts to decline. What would be above that high? Buy stops. Why do we know that? Because price started to decline, and we have to assume that someone's in there with a position, and where would their stop be? Right above this high. Price rallies through that, taking out the stops, and then once that occurs, our attention goes right to the low prior to that run on the stops. At some point in the future, this is going to be a bearish scenario if it's trading back up to it. We trade below it here, right there. Price comes back up, trades into it here. So it's similar to this. Right there. And down to the body right there. And goes right to the middle of the breaker there and sells off until it gets to a bullish breaker and trades higher, okay, up to a bearish order block. Nails it beautifully here, and now we had some retracement as a result. So you can see how using breakers, as you'll learn in the tutorials, one of the best ways to formulate an understanding of market structure is to incorporate these particular price patterns. Now, right away, you're probably not going to be able to capture this or see this in charts. You have to practice and look for them. I'll give you ways of doing that in the tutorials, but for now, so I just wanted to share with that idea in mind tonight how Euro has traded this week, and I have not taken any trades for disclosure's sake, but it's a wonderful example for those that have already gone through my tutorials. It's right out of the notes, perfectly delivered in terms of what I outlined for bullish and bearish breakers. It's going to be it for tonight, and I hope you have a pleasant weekend. Hope you enjoyed this week with me in commentary and examples. And until next week, wish good luck and good trading.